What's going on, everybody? Welcome back to Inside Trading, the channel where we break down the markets, the strategies, and the psychology behind money. I'm your host, Joe White, and today we're answering one of the most important questions every new market participant faces. Are you a day trader, a swing trader, or an investor? Just getting started in the market and don't know yet? That's okay too. Hopefully, by the end of this episode, you will have a better idea. Let's break it all down from history and taxes to risk, time commitment, and growth goals. Let's start with clear definitions. Later on in the episode, we will dive deeper into what is involved with each style. Day trading is the buying and selling of a stock within the same trading day. No positions are held overnight. Swing trading is the buying and selling of a stock within 365 days or less, typically held for days, weeks, or even months. And investing is when a stock is bought and held for 365 days or longer, often measured in years or even decades. People have been investing pretty much since the beginning of civilization. The first written examples of investing date back to Mesopotamia in 1700 BC. Hammurabi's Code provided the earliest framework for investing, covering loans, interest, and risk primarily for agriculture. In the Roman Empire, early forms of institutional investment and pensions appeared when soldiers were rewarded with land or silver. Jump ahead a few hundred years to the 12th and 13th century, where Italian merchants in Florence and Genoa traded commodities like silk and grain, pioneering early banking, credit, and bills of exchange. In the early 1600s, the Dutch East India Company established the first public stock exchange in Amsterdam to fund risky long-term shipping voyages. Following Amsterdam, London Stock Exchange was established in 1801 and the New York Stock Exchange was established in 1792, facilitating the growth of industrial era capital. Value investing was developed in the early 20th century by Benjamin Graham and David Dodd. Focusing on fundamental analysis and intrinsic value, many of the modern day investing strategies such as diversification and risk allocation come from this era and have evolved into what is essentially modern day investing. Today, I would describe most retail investors as index investors. This is due to the rise in 401k and Roth IRA retirement plans. Swing trading was formalized by George Douglas Taylor in his 1950s book, The Taylor Trading Technique. Taylor introduced the three-day cycle theory, identifying specific buy and sell days based on market trends. The strategy focuses on capturing intermediate price movements or swings rather than long-term holds. Over the decades, swing trading adapted to include modern technical analysis such as moving averages, RSI, and chart patterns, moving away from purely time-based cycles to trend following. Day trading really took off in the 1990s. Before then, day trading was dominated by large institutional traders in the form of high-frequency trading. The rise of the internet and electronic trading in the 1990s opened up day trading to the retail trader. Still, day trading was kind of something you really only heard about or saw in the movies. Since then, the introduction of online brokerages such as Robinhood has made it possible for people to trade anywhere in the world at any time from the comfort and convenience of their phone. Today, with just a few clicks, anyone can become a day trader. Nothing in the stock market is certain except for taxes and fees. Taxes and fees are one of the biggest differences between trading and investing. Since day and swing trades are both bought and sold in less than a year, profits are considered to be short-term capital gains. Short-term gains are taxed at an ordinary income tax rate and can vary significantly depending on income bracket. When it comes to fees, every time a stock is bought or sold, the broker gets their cut in the form of fees. These fees can quickly add up. If I'm making dozens or even hundreds of trades a month, those fees will cut deeply into my profits or add to my losses. If a stock is bought and held for more than 1 year, profits qualify as long-term capital gains. Long-term capital gains rates are typically lower than ordinary income taxes. This tax advantage is one of the biggest benefits of investing. Long-term investing has significantly less fees as well. Fees are usually only applied to a trade when a stock is bought at the beginning and then once again at the end when it is sold. The strategy of investing generally has less fees and taxes, allowing the compounding of an investment to have fewer interruptions. Now, I am not a tax expert by any means, so I recommend reaching out to your local licensed tax advisor if you have any questions on how your earnings are taxed. In my opinion, investing is usually the better way to go as it relates to taxes and fees. However, I primarily swing trade. Even with taxes and fees, I produce better returns with swing trading than I do with investing, so it's worth it for me. If I'm paying more in taxes and fees because I'm making more money, that's the right kind of problem to have. However, each trader has to judge how taxes and fees impact their own trading and investing style for themselves. Let's talk risk, because it's not the same for all three strategies. Day trading is extremely high risk. The numbers vary depending upon the study, but around 95 to 99% of retail traders lose money when day trading. This is due to the intense emotional pressure brought on by trading in extremely short time frames. The short time frames require traders to react in split seconds. This frequently results in decisions that are based on emotion instead of logic. Another reason why day trading is so risky is the use of leverage. I personally don't use leverage and probably never will. I would rather induce risk into my portfolio than leverage. This is the reason why I have never blown up an account or gotten liquidated. With the use of leverage in day trading, small mistakes can snowball quickly. This can lead to revenge trading, and that usually only compounds losses. In day trading, emotions run high, and big mistakes can happen in minutes or even seconds. Swing trading, on the other hand, has a moderate to high level of risk. With swing trading, the trader has more time to factor in the fundamentals and technicals, allowing them to make decisions that are based on logic rather than emotion. However, swing trading is still vulnerable to catalysts like news, earnings, and macro events, as well as overnight corrections that occur in the aftermarket trading session. Now, all stock trading has an inherent level of risk, including the risk of losing the entire principal. However, out of all three styles, investing has the lowest relative risk. This is because investing's longer time horizon smooths volatility. Investing still has risk and volatility, but over long periods of time, market downturns matter less. This is due to risk generally decreasing as the time horizon increases. Think Warren Buffett from Berkshire Hathaway. He has been investing for almost 80 years. Buffett's long-term investing strategy has made Berkshire Hathaway the 10th largest stock in the S&P 500. One strategy that I use to deal with risk is by turning day trades that go bad into swing trades, or by turning bad swing trades into investing. That's why I only trade stocks that I would feel comfortable holding for more than 5 years, regardless of whether or not I'm day trading, swing trading, or investing. Another way I reduce my risk is by trading and investing in American stocks and crypto. Full disclosure though, I have on rare occasions bought stocks in German and British companies. Let's talk about the tools of the stock trade. Day trading primarily uses technical analysis such as candlestick patterns, volume, VWAP, MACD, moving averages, and RSI. There is very little concern for fundamentals. Swing trading uses a blend of technical and fundamental analysis, including chart patterns, catalysts, earnings, sector momentum, and trend strength. Today, swing traders use short time frame charts such as the daily or 4-hour charts to identify, in some cases, 5 to 10% gains over days or weeks. I myself am a swing trader, and this channel is currently making a video on how I swing trade small cap stocks. Hit the subscribe button and make sure to keep an eye out for it. Investing is primarily based on fundamental analysis. This includes revenue growth, earnings reports, long-term trends, and management such as CEOs and CFOs. Investors are primarily looking for companies that have an incredibly strong business model, strong branding, a large advantage over its competitors, and the C-suite to not be involved in the day-to-day activities of the company. Warren Buffett was quoted saying a ham sandwich could run Coca-Cola, and he is Coke's biggest investor. Without knowing how to use the tools of your trade, you can't expect to produce the results you want to have. Day trading requires a large commitment, not just in time, but in money as well. Day trading requires a trading account balance of $25,000 in order to meet pattern day trading requirements. Day trading is a full-time commitment and consists of constantly watching usually multiple screens. If a short time frame setup is missed, a trade is missed. Day trading requires strict discipline and routines. With work, family, and friends, it is extremely hard to consistently follow those routines. Like many of you, I started off my trading journey by day trading. I was waking up at 5 a.m. to trade the pre-market setups, but quickly found that this style of trading interfered with my day job, sleep, and personal life. For me, day trading required a level of commitment that I just couldn't give. So I switched to swing trading. It suits me much better because it's part-time friendly, with a commitment level that works for me and my life. Swing trading requires daily or weekly chart reviews, requiring less screen time and more patience. The increased time frames allow for more logical and thought-out trades without the pressure of split-second decision-making. I personally swing trade. I make about 2 to 10 trades a month and mitigate my risk by spending a couple hours researching my current and future trades every week. For me, swing trading is much more conducive to my work and personal life than day trading ever was. Investing has the lowest time commitment. It requires periodic research and portfolio reviews. Investing time and commitment levels can best be described as set it and forget it. Each strategy is different, but they all aim for consistent profits that capitalize on compounding as the outcome. Day trading seeks to create profits with short-term income generation through consistent daily or weekly profits. Capital preservation is critical to maintain growth and income. Swing trading focuses on medium-term capital growth by capitalizing on larger percentage moves over days, weeks, or months, while always trying to maintain a balance between opportunity and risk. Investing is centered around long-term wealth building through compounding returns by focusing on decades, not weeks or days. Again, think Warren Buffett. There's no best style, only the one that fits your personality, your time availability, your risk tolerance, and your financial goals. Some people day trade, some people swing trade, some people invest. The smartest market participants understand all three, even if they only participate in one. If you would like more information on day trading, swing trading, or investing, I have included a couple links below for books that cover these subjects. This has been another episode of Inside Trading. Thanks for stopping by. I'm your host, Joe White, reminding you to plan for how you act or act for how you plan.
This video is for educational purposes only and does not constitute as financial advice. The hosts and guests may hold positions in stocks discussed. Opinions and strategies expressed are not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any financial decisions.